Hey everyone, how you doing today? So this is the start of our expert series for the week, and as promised in our daily financial news, we're going to flip the script a little bit this week, and we're going to talk about, hey, what could surprise us? What could go wrong? It's about protecting the downside so the upside takes care of itself. And you all know we start out hot on Mondays, and we bring on Greg Dickerson. How you doing, buddy?
Doing great, Michael. Good to be here.
Excellent. So just in case, folks, you hear this little subtle whine on the mic, I'm not sure how sensitive it is. This is Jimbo. He is 15 and a half. He is not happy this morning. So I will try to keep him quiet, but I don't think I'll be successful for the full hour, but we'll see what happens. So Greg, thanks for doing this. We've actually got 4 topics today because I think there's 4 areas that could surprise us. And we're going to start off with the big one that everybody's mentioning today, inflation. And also I want to sprinkle in deflation because I think, if we're really talking about what could surprise us, it could be either of those things. So what do you think about that?
Yeah, so I think inflation is more of a possibility than deflation. So with, the potential of the policy that we have facing us with the Democratic controlled legislature, House, White House, and the policies that are being put forth. I mean, we got some pretty big stuff that, that Biden is proposing to stimulate the economy and redistribute wealth. So the direct effects of that could be, serious inflation at the consumer level, which is, we're kind of seeing a little bit. The Fed wants to target inflation, but here's the thing. So if you get a bunch of money put out on the streets through infrastructure spending, writing people checks, doing a number of different things, and that spurs economic activity and growth in demand, consumer demand and production, that's going to drive prices up. Then the Fed, wanting to target some inflation, what is their response? They raise interest rates. And what does that do? Mm-hmm. So interest rates are going to affect the housing market. It's going to affect financial markets. So you could see the perfect storm in and through inflation, through economic policy to try to get us out of this mess. Mm-hmm. That could actually backfire and put us into a bigger mess. Yeah. But at the higher levels, they're going to be in more real estate, more financial markets than anything else.
Yeah. So let's talk about inflation a little bit more in detail. I think the Fed would really enjoy something between 2 and 3% inflation. I think they'd really enjoy that, right? Kind of inflate the debt away. Mm-hmm. I think the real fear is inflation does, kind of pops to 4 or 5% and kind of really force their hand, right? That's really what we're talking about here. And that would force a reaction, meaning coming off the sidelines and raising rates before they wanted to. Is that fair to say?
Yeah. Yeah, I think that's the key. And then we all know what the reaction to rising rates is. And,
we got a taste of it just the last 2 weeks, right? Just a small taste.
Right. So you'll get deflation in assets, just like we have hyperinflation in assets right now. Mm-hmm. You'll get hyperinflation potentially in the consumer level. So yeah, it's a tough one, man. It's a tough one. It's a slippery slope. Everybody's talking about it. Nobody really knows the right solutions and the right ways to get through this and to get everybody off of this, artificially inflated financial markets system that we're in right now. I don't even know what you call it,
Yeah. Yeah. I think it's, I don't know what to call it either. Maybe just more proof that you can't bet against the Fed. I think I just want to hit a couple of things you said more importantly, right? I really do think, and you've said it a couple of times, but I want to call it out. There's 2 types of inflation going on right now. There's the consumer-based inflation, which is what we were referring to. The Fed wants 2 to 3%. It's bad if it gets to 4 or 5. But there's been asset inflation. If you haven't seen asset inflation since March lows in the stock market and or real estate, you're really not paying attention. And it's going to be interesting to see consumer inflation, if it comes to be, that feedback loop to asset deflation, right? That really could surprise people. And again, it makes kind of sense, right? Just think about multifamily or commercial real estate that's valued on a cap rate, right? There are plenty of cap rates being done today at 4.5 or 5. But if you get consumer inflation to say 4%, the Fed takes it, the 10-year goes from 1.1 to 3.5. I'm just making stuff up now. That spread between the treasury and a cap rate on a building's got to expand, right? And the only way it does is it goes up. And then if that goes up, value goes down, right? Does that logic make sense?
Yeah. Just like residential, as rates rise, values go down. And, there's a correlation of, for every 1% that rates go up, values come down equally. And we've seen it over and over and over. And, so how do you get inflation at the consumer level? That's the real question, because we haven't seen it. We've been pumping money into the economy since 2008 and 9. The Fed's been down this road, and we haven't, printing, and, pumping up financial markets, keeping interest rates artificially low. We haven't seen hyperinflation at the consumer level. Why is that? So it's demand. It's all about demand. People do not have more money. That's the issue. So if now new policy puts money in consumers' pockets through the government sending checks, through universal base income programs, through guaranteed job programs, through infrastructure spending. If all of a sudden we go out and put $1 trillion into infrastructure projects, that's going to create jobs. It's going to create demand for materials, which is going to put money into consumer pockets, because it all trickles down. So, that's when you could potentially see things. But the real issue there, so even thinking about all that, the question is, how do you get there? There isn't enough labor to do $1 trillion worth of infrastructure execution. You could spend the money and you could put the contracts out there, but to execute on that, there isn't enough labor to even build houses right now. You can't get the materials, the supply chain's clogged, you can't get the labor to actually perform the work. But if you could, that would put a lot of money out on the street, which would drive, demand for a lot of different things, which would drive inflation for products. Now, what drove it last time was people being able to tap equity. You can't tap equity now as easily as you could before, because you have to qualify. So a lot of people still can't qualify. They might have a house, they might have equity, but they can't get it. So if that changes and people can tap equity, and put money in their pockets, then that can drive demand, which could create hyperinflation. Then the Fed has to respond, raise rates, and it all comes crumbling down, and they got to do it over again. So, it's kind of a vicious cycle.
Well, the other thing you said a couple of times, I want to just put a number on. You've said hyperinflation a couple of times. You're not talking Germany hyperinflation of 100% or something. When you say hyperinflation, what do you mean? Like 10%? Or when you say that word, let's try to put a number on it.
Yeah, hyperinflation at the consumer level, you could see, well, look at housing. I mean, housing has gone up 20% in the last year,
Yeah.
So to me, that's hyperinflation at the asset level. Look at the stock market, 30, Dow and S&P and all that hitting record levels. I mean, it's up 50% from where it was. That's hyperinflation.
Yeah. And
so,
again, I just wanted a number on it. So 30, 40, 50% in a year. It's not 100% in a day.
I'd say 10 to 20%, the CPI index, I mean, they already said we're up 2% in this cycle right now. So, I mean, you could see a real 10 to 20% in the CPI, consumer price index.
Yeah. The other thing to talk about on this topic, but before we round up, number one, is a lot of the supply side issues are really just more evidence that our supply chains are broke. Like I've seen issue about lumber, right? And when you peel that back, what happened on California West Coast fires, they were shut down for a month, and we kind of still haven't made that up. The other one that really surprised me in the last 2 weeks I've read about is car chips, like chips that go inside cars. Honda, Hyundai, and Mercedes have all had to shut production line or really slow them down because they can't get chips. So again, this is just more evidence that our supply side is broken, right? Just in time has come back to bite us because somebody in the food chain, is out sick or whatever it is. But what I'm wondering about,
lumber, so there's hyperinflation there. So a lot of people that aren't in the business weren't aware of that, but lumber prices went up 300 to 500% on certain items, for a while there, and still is kind of up, at least 100 to 150% on certain items. Construction alone costs are up probably 30% in the last 2 years.
Yeah, no question. What happened in lumber is definitely an example of hyperinflation. The fact that a 4x4 was up 300%, and I don't know how many 4x4s go in a house. But yeah, that was definitely, and that's actually why some builders slowed down, right? Pulte Homes on their quarterly report in Q4 said, you know what, we don't believe this inflation in raw materials is transitory. So they're just going to slow down. Right. And
so here's a big one most people can understand. So if you've driven by a house and you see the OSB, that's the 4x8 sheets of plywood type material that are on the exterior of a house. So most people see that going up when they start, putting the plywood and the sheathing on the exterior walls. It's kind of flaked, for people that don't understand. It's like wood chips compressed into a plywood type product. Normally that's $8 to $10, maybe $12 a sheet for 4.5-inch 4x8 sheet. It went up to $100 or more. In some areas, it was a couple $100. Wow. That's serious. Drywall, for a 4x8, 4x12 sheet of drywall, normally around $15 to $18. That had gone up to $100 in some areas. So
my goodness,
that's the kind of stuff that you're seeing when the supply chain gets contracted. Not so much demand where everybody's got money, but a lot of it was there's so much building going on, and that's why prices are staying high, that labor and materials are up. But it's all cyclical. That's going to turn around. But if
Hmm.
you throw infrastructure on top of that and you stress the construction industry even more,
Hmm.
that's where you're going to really see prices go through the roof, because a lot of these, especially on the labor front, because a lot of people are now, instead of framing houses or working on job sites in a residential community for 15 or 20 bucks an hour, are going to be able to go to these government contracts and get 5 times their rate, because
Yeah.
it's going to be government rates. They can get 20, 50, $100 an hour versus, 10, 15, $20 an hour over here. So that's going to create a real problem as well.
Yeah. So what I think you're hearing, again, thing to watch out for me that maybe I didn't know before this is really watch the infrastructure bill, because again, Biden's already come out and said that's step 2 of his plan, right? Step 1 is
Mm-hmm.
this stimulus plan. Step 2 of the dance is going to be infrastructure. And you're right. What is that going to do to the labor picture, right? We're already,
Yeah.
again, residential, not building enough homes, if you believe what the stats say. But then you strip away 30%, 40, 50% of the labor. What happens then, right? It's going to be interesting to see, because again, you get
Yeah, I
competitive
think it's
on
I think
rates.
it's a good thing. I think we need that.
Oh
I
yeah.
mean, obviously we need that. So I'm not saying it's a bad thing. I'm just
No.
saying, like you said, what are the surprises that could come from it, and unintended consequences that you get from good intentions.
Yeah.
So these are some of the things that'll be interesting to watch and see how it really affects,
Yeah.
all of those other areas.
So let's go. Let's just touch on deflation. We hit a little bit. We see it potentially kind of circling around to hitting assets. Do you see any chance that deflation hits the consumer level, right? Cost of food, cost of gas, the stuff that goes into the CPI? Any kind of.
No, we haven't seen that at all, even in the worst of times,
Mhm.
because there is support. There is support to a certain level. So I don't see it there. I see it in assets. I
Yeah.
think there's a big deflationary risk in front of us, and headwind at the asset level. Housing. I mean, it's just inevitable. Rates are going to have to go up at some point to taper this,
Yeah.
especially with all this that's getting ready to get pumped into the economy. So you're going to have to raise rates, which is going to create deflation at the asset level. I don't see deflation at the consumer level unless, everybody just quits spending money. And, now certain things, people might stop buying cars. They might stop, buying discretionary purchases. But in terms of things you need every day, gas is up again.
Mhm.
OPEC said they're cutting back production. So that should go up. Demand is going to be coming back more and more as we get through this and we get back to work and get the virus behind us, which again, we still have a long way to go yet.
Mhm.
Several months, fall probably before we are likely to see any kind of normalcy again, and everybody's vaccinated that wants it. So it's interesting times, but I don't think deflation at the consumer level is even possible right now.
Yeah. No, I agree with all that. Thank you very much. This has been a lot of fun. Episode number 1. Thanks, buddy.